All right, so we'll use that. So the concept of principal and income law simply indicates that when you have principal and income law, you've got this irrevocable trust. You've got two different sets of beneficiaries, an income or present interest beneficiary, and then you have future interest beneficiaries as well. When we look at those two pieces, obviously we need to keep an accounting. If you take it from a very literal sense, let's assume that you have an account that has a portfolio in it, and from that portfolio, all the income is distributed to Class A, and when Class A passes away, then everything passes to Class B. Well, obviously, Class B is going to get the principal, and if the assets have risen in value or lowered in value, that's what they're going to get. The present beneficiaries are going to get all of the income, right? Trust accounting income from those assets. So the assets basically are the principal, and what they earn is the income. Trust documents are not that strict in most cases, but it's the best way to understand what the foundation of principal and income law is, where it comes from. Then we'll mess around with it, all right? So the income beneficiaries obviously need to have a statement. So you're going to have a statement for the income beneficiaries, and you're going to show that cash that's in their accounts. You're going to show the assets that are in their accounts. You're going to show the inflows and outflows. We're going to have debits and credits coming from this account. In addition to that, we've got our remainder beneficiaries down here. So we've got a principal beneficiary statement. It's showing for them what cash is in your accounts, what assets are in your accounts that will eventually flow to those principal beneficiaries, and we'll have debits and credits that come from those accounts. The problem is, in keeping those two different statements, that the reality in our business is many times the document allows us to dip into principal and give money to the current beneficiaries, discretionary distributions, for instance, out of the principal of the account. So we can't separate those two statements. What we do instead is we put those two statements side by side on the statement so that nobody knows what's going on, and we end up with a statement that looks something like this. And that's why they call it double cash accounting, because basically you have two accounts going on, and you'll notice that there's two cash columns, one for the principal, one for the income. In addition to that, really there's two asset columns, because you could have, you don't often have, long-term arrangements inside of the asset column on the income side, but you certainly can. You can invest for the income beneficiaries just like you can for the principal beneficiaries. It depends on the language of the document. So Jason's asking a question, how is long-term capital gains and qualified dividend income taxed? Well, tax is a whole different thing. Right now we're talking about property law, not income taxation, two very different things. We have to separate in our minds the idea of what is the right to property of various beneficiaries versus the taxation of that property. Two very different things. But I'll answer your question. Basically, long-term capital gains have to do with the up and down of the assets, right? It's not income. It's income from an income tax standpoint. That's a taxation concept, not a property law concept. In property law, long-term capital gains is an asset rising and falling in value, and therefore is taxed remainder beneficiaries. Well, how do you tax remainder beneficiaries? You tax the trust, because that's what's eventually going to pass to them. You can't tax them currently because no distributions are going out to them. Qualified dividends are a whole different thing. Dividends are a form of income produced from a stock, and therefore in trust accounting, dividends are treated, even qualified dividends, are treated as part of the distribution to an income beneficiary. Therefore, the taxation shown in our D&I concept, we'll get to that when we get to fiduciary income taxation, will flow out to those income beneficiaries. So very different for those arrangements. Now, you also said tax inside an irrevocable trust. So I'm going to read something into that. Let's assume that no required distributions are made. Everything is kept inside of the trust. Well, then the trust has the same rates that you and I would, right? A maximum rate on qualified dividends and long-term capital gains of 20%, just like individuals do. So we'll deal with that more in detail when we get to the taxation. This is why we're looking at these pieces one at a time, to really understand. Because if you start messing with, before you really understand each of those concepts individually, people start mushing everything together, and that's when they get into trouble, right? That's why most people don't have a great grasp on the trust area, is because they try to do everything at once rather than understanding the components. Once you understand the components, then you can start bringing those pieces together, and it makes a lot of sense. But it's understanding each of the Lego blocks individually that helps you with that eventual answer. So it's in, I believe, our next class that we're going to be doing fiduciary income taxation, followed by estate and gift taxation. So we'll follow up on that concept, Jason. But does that help for the short term? Very good. So our statement ends up looking like this. And let's just give us a basic run-through of what would happen. Let's say that Grandma passes away. Sorry, Grandma. And so Grandma passes away and she leaves some stuff. Well, basically all the stuff she leaves is going to be